WTI appears to be ending the week near last week's closing figure, with markets appearing uncertain as to the commodity's next direction. Oil traders continue to grapple with conflicting fundamentals of tensions in the Red Sea, OPEC's oil demand expectations, and the deteriorating stability in the Middle East, which continues to threaten one of the most vital oil arteries in the world. In this report, we aim to shed light on the catalysts driving WTI's price, assess its future outlook, and conclude with a technical analysis. OPEC's monthly report was released yesterday, in which the oil cartel announces projections for the oil market outlook for 2025. According to their projections, global oil demand is expected to grow by a robust of 1.8 million barrels per day, which implies that demand for oil will remain elevated. Moreover, the group projects that a shift to more accommodative monetary policies is expected second half of 2024, implying that monetary policy may begin to ease in the second half of the year. As such, the report could potentially be perceived as optimistic for the oil market, and thus could provide support for oil prices for a more macro perspective. Yet, should the cartel's expectations of easing monetary policy by the second half of 2024 not materialize, we could see downward pressures on oil prices being exerted. On another note, the Baker Hughes oil rig count, which was released last Friday, indicated that demand for oil may be declining, as the count dropped back down the 500 figure by coming in at a total of 499, which could weigh on oil prices in the long term. Therefore, should the Baker Hughes oil rig count decline further, implying a further reduction in demand, it could weigh on oil prices. Whereas should they begin to increase, thus implying increasing demand, oil prices could find newfound support and potentially move higher. Despite the USA's and UK's attempts to deter the Houthi rebels in Yemen from continuing their hostilities against shipping vessels, the group does not appear to have heeded the warnings in the form of bombs and airstrikes. According to Bloomberg, 3 commercial ships this week have been struck by drones fired by Houthi rebels in the south of Yemen. As such, the continued tensions and military escalation could further prolong the resumption of trade via Suez Canal, and could also continue providing support for oil prices as the supply chain for oil continues to be shrouded in uncertainty. However, in our opinion, the markets appear to be relatively unfazed by developments in Yemen, and as such, any material impact on the oil markets would have to be as a result of a significant military escalation or the resumption of trade via Suez Canal. As if the world didn't have enough military conflicts, Pakistan and Iran appear to be ready to go at it with each other. Iran on Monday fired missiles into Pakistani territory, claiming to have been targeting the militant group of Jaish-ul-Adl, with Islamabad responding by firing their own missile strikes into Iran. Given Iran's status as an oil producer, and that the nation's territorial waters coincide with the remaining trade route of oil from the Middle East into the international markets, a potential disruption of that area as well could cause irreparable damage. Therefore, should the two nations continue their tit-for-tat approach, it could lead to higher oil prices, as the viability of the world's crucial oil artery is once again placed under a cloud of uncertainty. Yet for now, the impact appears to be minimal, but is something worth looking out for the coming week. Looking at WTICash 4-hour chart, we observe the price action appears to remain relatively unchanged since the beginning of the week. We maintain a neutral bias for the commodity, and supporting our case is the RSI indicator below our chart, which currently registers a figure of 50, implying a neutral market sentiment. For our sideways bias to be maintained, we would like to see oil remain confined between the 71.30 support level and the 73.30 resistance line. Yet we should note that the distance between the S1 and R1 levels is fairly narrow, and as such could easily be broken. Nonetheless, for a bullish outlook, we would like to see a clear break above the 73.30 resistance line, with the next possible target for the bulls being the 76.35 resistance level. Lastly, for a bearish outlook, we would like to see a clear break below the 71.30 support level, with the next potential target for the bears being the 68.20 support line. As this report concludes, we would like to thank you for being part of our financial updates. From all of us here at IronFX, we wish you a solid trading.